Good afternoon, everybody. Just give me one quick second here. Okay. Everybody can hear me? We working okay? I'm like anxious after yesterday. Nothing frustrates me more than technical difficulties. Working on some stuff. Actually, let me do this disclosure first. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There's the position disclosure. It's unchanged. Just because, you know, I traded every single one of these stocks today, just so you know. But the position disclosure itself stays unchanged. But I'm in and out. Sizing down, sizing up, creating cash flow. Okay, hopefully the internet holds up. Again, that really gives me like almost anxiety when what happens yesterday happens. I get very upset. Worked with the internet company a little bit yesterday. Made a couple of changes. Hopefully that helps. I'm also waiting for them to send me another part. Hopefully that helps. I also have a hotspot, but for some reason my hotspot hasn't been working here. That's what I was using when I was in Indianapolis without any problems. Yeah, hopefully it's all good. Hopefully it's all good. Okay, cool. So let's run with it. So let's take it back to, actually, real quick, just let me post this here in the VTF. If anybody missed yesterday's afternoon meeting, I did like a little synopsis video of kind of the macro stuff that I put on YouTube, so you can watch that in case you my afternoon meeting was like unwatchable. Anyway, so let's do a synopsis of today, starting with our game plan from the morning meeting. So coming into today, it almost felt like we were kind of stuck between a rock and a hard place. On Friday, we had this fantastic breakout, positive economic news, or news that's at least positive for markets, broke us out of a range that we had been in for 13 days. As a general rule, markets work in periods of expansion and consolidation over time. And a lot of times the larger the consolidation, the larger the subsequent expansion. So really tight 13-day consolidation. This almost seems tighter, and this was the end of 2022 into 2023. I know it encompasses some holiday trading sessions. This almost seems tighter than anything that we had seen in all of 2022. We never really got any tight sideways price action for a period of time. But we did. We got this tight sideways price action, and we're going to break down, or we're going to break up. There were times when we looked like we might break down, times when we might break up. And then eventually, with the help of some economic numbers on Friday last week, we had a great breakout through key levels for the SPY, for the IWM. The Qs actually did not break out on Friday. They got right to the resistance level, and then kind of gave a little bit of continuation yesterday morning. And for the last 2 days now, tech has actually showed some relative strength. Then yesterday came. Yesterday morning we had a gap up, gapping to key 390 level, which is our next major area of resistance. It was a common gap into it. We know that common gaps to the upside have very consistently been heavily sold over the course of the last like 2 months now. We wanted to see if yesterday's gap up could be different, given that it was following a major market breakout. And it was yesterday morning. It was. We held that gap perfectly. It pulled in a little bit of price correction, let that ADMA catch up. I love this kind of playbook here where they don't fully fill the gap and the market's going to be really strong. You get an early pivot, the ADMA catches up to it, and then you're off to the races, supported by some of that zero DTE gamma profile stuff that Bill K has been posting for us every morning. Helped yesterday. And then we really died out. The degree of the rollover yesterday was very disappointing. It brought us back to some key levels, but not necessarily below them. But the concern is that it left us with a big topping tail. And in my opinion, that topping tail was too early. You know, if this was like day 3 or day 4 and we were extended and we were at like $400 or above $400, and then I got this type of candle here that was indicating a technical pullback for the market, I'd be like, okay, fine. You know, we had a big breakout, couple days of follow through, and now here on day 3 or day 4, the market's struggling to give continuation. That's fine, that's normal, that's healthy price action. But for day 2 to give the opening move just to roll over in the afternoon and give this like shooting star type candle, that's not a good signal. It's not the end of the world either. So what does yesterday's candle actually mean? Or what does any shooting star actually mean? Or the opposite is a hammer candlestick in candlestick analysis. All a shooting star really means is that you should look for technical retracement to the equilibrium area. And again, usually we want to pay more attention to that in areas of extension. Because areas of extension, this could actually be a short signal where you're looking for a move back to that equilibrium zone. But typically if there's no extension, we don't want to take the trade because it's not a good risk reward. So this didn't set us up for a great short for today. On top of that, even though yesterday's candle wasn't great, we weren't below any key levels. If we were to get back below SPY 385 today, that's what we talked about at the morning meeting, if we were to get back below SPY 385, then we might be looking at a false breakout. We're right back into the range. And if anything, sometimes a false break in one direction actually leads to a bigger move in the other direction because they just faked everybody out. So, 385 on the downside, below there, I felt you could become bearish because you start to lose key levels. You're back in the consolidation. It looks like a false breakout. But we were above 385 pre-market this morning, even as we were gapping down. And this candle yesterday, all it really technically indicates is a pullback to equilibrium. Equilibrium was not very far away, so we pretty much got that this morning as well. But it was still concerning to get this topping tail. So this morning's game plan was really primarily about capital preservation. And it's important for everybody to remember that capital preservation is a really important part of the trading business. We always want to talk about the glory of the great trade, the home run, the great call out, things of that nature. But the kind of unsung hero out there is really knowing when to preserve capital, when to take your foot off the gas pedal, and focus on your risk management and your money management. And that I really felt was the setup for this morning. We're above a breakout level still. Do I really want to be shorting when we're above a breakout level when we just had this big breakout 2 days ago? No. Do I want to be shorting because of yesterday's candle for a pullback to equilibrium? No, it's a terrible risk reward. Do I want to be coming in and buying this morning when we're below 390 again? We got above that second level 390 yesterday but came back down and failed. And do I want to be buying the day after a shooting star candle? Again, the answer is no. So when I'm trying to come up with a game plan this morning that can give me a key advantage for the market, well, my signals are telling me don't buy, right? I don't want to buy right after a shooting star like that when we should have been able to get more continuation. And they're also telling me don't sell. Why do I want to short into equilibrium when we're still above a breakout level? So you kind of have to go into that capital preservation mode. Less is more. Be patient. Wait for the market to actually break key levels in one direction or the other, and then the market can begin to tell you what to do again as far as looking for continuation to the upside or the downside. And the big picture game plan for me was if, I think we opened up at 387 or something like that, or maybe it was below that. 387 quarter. Low of the day is 386 quarter. If we start getting below 385, I'll become increasingly bearish. If we start getting above 390, I'll become increasingly bullish. Let the market prove it to me. Be patient and focus on capital preservation. Don't get chopped up in the middle. And I think it was a great game plan. And again, I hope everyone followed it. Knowing to preserve capital is as important and sometimes even more important than making money. And then look at this intraday price action today. This intraday price action is garbage. Really tough. But are you surprised to see intraday price action that looks very uncertain, isn't giving follow through in any direction, given the big picture stuff that I just outlined? I don't think so. I think that this sloppy, gross, awful price action that the SPYs provided us today is exactly what your expectations should be based on the big picture game plan that we just discussed. And if you're focused on capital preservation, you're not pushing it when the opportunities are not there, then you're doing pretty little based on this. We got up to, opening bar was strong. Okay, we can always focus on relative strength and relative weakness when we're more uncertain about the market. We can always focus on names that are in play to act, less correlated to the market. But again, this intraday price action, red to green right away, positive Maribozu right away. Okay, that's a positive sign, but are we above key levels? No, we're not. This is a good start for the bulls, but we're not above key levels. And I remember when we pulled back here in these second bars, I was like, this second bar here, we really need a lower high versus this bar. I don't want to pull back. The same kind of retracement rules that we look at bigger pictures also apply on smaller pictures. I don't really want this positive Maribozu to lose more than 50% of it if we're going to get momentum, if we're going to go after this 390. And guess what? It failed. It broke down and broke that opening low. And then it kind of tailed back up. I mean, this is just super sloppy price action. And then eventually we broke that opening high. We went after 390. 390 is a key level. We failed at 390. Then we made new lows. This is so hard. We're ripping higher. We're making new lows. We're making new highs. We're making new lows. How do you trade that? Trading the SPY here, to me, this price action actually looks impossible. Again, there were individual stocks out there that we were focused on that were better. I remember this Amazon pattern. Amazon showed a lot of relative strength off the open. Amazon was able to be green, open green when the market opened up red, so we had that relative strength. Technical pullback here that we were looking at potentially buying, and then I called out a long through $89 versus the low from 10 a.m. That trade worked, and even that one actually eventually shook out. The low here is I think like 8 cents below this low. But that was a good trade that we were able to kind of pay attention to and focus on. But there were a couple others that were out there that were similar to this. I actually can't remember. Amazon was my main focus, but we called out like 2 or 3 names around this time that were showing a little bit of relative strength. But the market here tried to go. This is when the market tried to go, and this is when the market failed off 390 and eventually made new lows. So even a name that's as relatively strong as Amazon, it still didn't have the market supporting it. So I do recall saying here, if anyone was taking the trade at $89 for Amazon, I think a bunch of us took it, was this is not an A+ trade. I'm looking for some diamonds in the rough. I'm looking for spots to make cash flow, but you should not be going max risk on any of these trades. What's on the side of the trade? The relative strength is absolutely on the side of the trade. I think that this is a good intraday pattern for an intraday breakout for continuation, but the market's not on the side of the trade. Right? So, there are things that are against it, and there's some things that are helping it. It's just not going to be an A+ setup. Put a little bit of risk on it. Big enough of a move to at least get your risk covered, if not book a little bit of profit, and then it still pushes you out when the market makes new lows. Honestly, it still showed relative strength even when the market made new lows. It never would have broken this pivot low that I was, calling for as a stop loss. If the market wasn't making new lows at the same time. And then even then, 90 acted as a wall here of resistance for Amazon. So there were a couple, decent call outs for this intraday break higher on a few stocks. There are a few areas of relative strength where we were able to make a couple bucks. There were a couple names in play that we discussed in the morning meeting. I don't know if anybody was able to capture them. You kind of had to pay up a little bit, but I think that like AMPS. Oops, typed that in the wrong place. I think that AMPS kind of worked out, but it was tricky. You really had to wait for like that equilibrium to catch up. So it was really just a day of less is more. The market here choppy, and then just finally into the close, we got what we were looking for all day, which is a decent close and a break back above 390, and an okay close at like 390.50 or so. So at the end of the day, we have an okay candle here, and it puts you, I think, a little bit more back in the bullish camp, like we were talking about in the morning meeting today. If we can get above 390 and hold above 390, we get back above that level, we retrace some of yesterday's afternoon sell-off, then you can begin to feel a little bullish, pun intended towards feeling bullish. And if we get below that 385, then you can start to become a little bit more bearish. So that's kind of how the SPYs ended up working today. Again, I really think it was more about capital preservation. The Qs gave us a good close above 270. Tech was where the relative strength is. There was a good note. Shane's been posting this, the chartreport.com every day, and there was an interesting note. I remember there was chatter just in yesterday's afternoon meeting, or yesterday, I think, even during the day, about Dow relative weakness versus the NASDAQ, and I was like, well, you know, it's notable because the Dow's been kind of a leader, but it could just be some mean reversion. I think we saw a little bit more of that mean reversion today. And again, Shane had given us kind of this chart of the day from the chartreport.com. This is a cool thing that I hope everybody reads every day when Shane posts it. Just a good piece of kind of technical information. I usually scroll down here through a bunch of these charts and kind of check it out. But this chart of the day also talks a little bit about the possibility of mean reversion based on some technicals, which I would encourage some people to take a look at if you didn't already look at it this morning. So Q's given a close above 270. It's good. We still did not negate the tail. And IWM leadership though. This IWM. This was the one thing I said in the morning meeting that still makes me optimistic. Is that the IWM chart was off of more of extension. Yesterday's kind of pushed through failure than the SPYs and the Qs were. And to me, this just looked okay and right for continuations. Anything that was able to get above yesterday's high today is showing you really good relative strength. And we, as a team, certainly like when the IWM is giving leadership. This has been a consistent signal, leadership to the upside and to the downside, that the rest of the market can follow through in that direction. I love that the IWM was able to get above yesterday's high. So I think that after today's close, given the IWM above yesterday's high, the Qs above 270, the SPYs above 390, we can kind of go back to being cautiously optimistic, but we'll see where we gap to. We'll see where we gap to tomorrow. We'll take it from there. And then obviously we've got the CPI on Thursday, which has just become such a massively important number for this market. And then earnings season kicking off right after that, which should be very interesting. I think that covers all I had on my end. So I'm happy to take a look at any questions or anything that you guys are looking at. So the first thing I believe I'm seeing is from Sue. I did a trade the other day that failed. I thought my stop loss was in right after I had bought the stock, but when the price started going against me, I noticed the stop loss was not in. I don't know why. I probably made a mistake. I exited the trade immediately, but of course my loss was bigger than initially planned. What would you have done in this case? Would you have exited immediately as well, or would you wait? Sure, Sue. So I've definitely found myself in that scenario. It's not a scenario that you want to be in. Obviously, the best case scenario is just to ensure all your orders are in the right place and that it doesn't happen. But if you trade long enough, it will happen to you. It has happened to me. So in that scenario, what do? I kind of reassess. I don't think it's the wrong answer to auto liquidate the position. You were planning on having a certain amount of risk. Whatever happened, you're losing more than that. I don't think it's wrong just to say, oh my God, I can't believe this happened. I need to manage my risk and auto liquidate it. That's not what I typically do at this point. What I typically do is I just reassess the trade for where it is. I ask myself, if I had stock right now from the price that it got into, that it's trading at currently, what would my trade look like? Where would my stop loss be? What would I think my risk reward and probability of success is? And I would reassess where it is and put a new stop loss in based on where it is. So for example, just use some random numbers. If you bought at $50, stop loss is supposed to be at $49.90. You don't realize that your stop's not in. Next thing you know, you look at it, it's trading at $49.75. It's 15 cents past that, but it already put in a low of $49.68. I'm probably just going to put my stop loss in at $49.70. That's $49.67, a penny below whatever that new low was. And I might even actually add, which is going to add even more risk and make the loss even bigger if it fails. But I might even try to add at that point to average down and try to manage the position a little bit and see if I can work my way out of it. So I kind of treat it like a new trade. A lot of risk managers, and I don't fully agree with this. A lot of risk managers, it's always about where the positions are at any given point in time and where the portfolio is at any given point in time, that they're making kind of their decision based on. And that's what I think you need to do when you find yourself in that scenario, which is just, all right, this is the situation I'm in. It's a bad situation, but what game plan should I have from this point that makes the most sense where I can, risk it? Because at that point, like using the example that I just used, if you find it at 75 cents, it already went down to 68 cents, and it's already 15 cents past where you were supposed to get out. At that point, what's an extra 7-8 cents, to be totally honest, if it gives you the opportunity to try to manage the position and work your way out of it. So that's what I would do, Sue. I hope it helps. Next from Rex. Today I tried to go long NVIDIA. Cool. Today I tried to go long NVIDIA. So NVIDIA was one of the names that we mentioned this morning. AMD and NVIDIA both showed relative strength in yesterday afternoon sell-off. So it made sense to have them on our radar for today in case the SPYs could get above 390. If the more bullish situation from the market happened, which I would argue it didn't happen, that these would probably be better names to look for. But you certainly had the relative strength coming from yesterday. So let me read the rest of your question. So you went long NVIDIA at 950. Okay, right when it barely held that opening low. This is very sloppy, similar to the SPYs. When I saw the volume coming in, okay, there was a little bit of a volume uptick. Thinking NVIDIA was strong pre-market. The daily candle wasn't that ugly compared to the market. Exactly the things we talked about. I longed it when it broke the 945 candle and came back. Okay, so you basically went long, it looks like here. My price was 155.61. Oh, it's a I see. When it broke this candle down and it came back up is when you bought it. So it seems like the entry price is a little bit late. That's what you're doing there. Versus the low of the candle before it formed at 155.02. Oh, okay. I think I understand here. And it got stopped out. Would you say that it's unlucky? Would I say it's unlucky? No, I don't think I would say it's unlucky. I don't love your trade. This is another one. This is like what we're saying, based on today. Today was a day to do less. So, like, I see your trade. I understand the layers of probability that you're looking at. I understand why you went long. But it's certainly not, and I'm sure you can agree with me, like an A+ type of setup. You got a little bit of a trade setup here. You've got some degree of relative strength. But you don't have any support from the market. And the flip side of your buying here is that it shouldn't even be retesting this close to the low of the opening candle even to begin with. So, I think it's like I think it's a trade that was probably worth taking, but you got to give it a pretty low grade. And when you're just working with lower graded trades where you've got less layers of probability on your side for it, that just means that there's a higher probability of getting pushed out of the trade or the trade just failing entirely. And then I know it kind of went and worked a little bit there, but I wouldn't say that it's unlucky. I would just akin it to what I was saying earlier. Even when I was talking about the Amazon trade that I had called out to the team, it just isn't a trade to be going like heavy risk on. There was a very good probability that Amazon call out I had today was not going to work, or not work at all, let alone if that worked a bit and then it failed. There was a decent probability that wouldn't work at all. The market wasn't supporting it. You had great relative strength, better relative strength in Amazon, honestly, than even in NVIDIA. But there's no reason to be going heavy on any of these because they can all push you out. And I really just think that that's what happened here with this. So also you went long Amazon at 10. Okay. Amazon at 10, risking the low of that candle. At 10:45 it got stopped. Do you think that this was the appropriate stop, or should I be using 9:45 instead? No, so this is similar but slightly different to the trade that I was talking about, which was the break of 89 versus that low. Looks like you got in a little bit earlier, so you ended up having like a little bit of a better risk reward, but no confirmation when the trade actually worked. I think your stop is 100% appropriate. It's the same stop that I was looking at. You also recognize that Meta was holding well. Excuse me. You also recognize that Meta was holding in very well. And I'll tell you one thing about this Meta, and I noticed it too late and I was kicking myself. Off the open, Meta gave a great spot on the daily chart to be able to look for getting stock. This gap down into the 80 MA, you know, we've been looking at this Meta. We had calls out back here for longs through 118.70 and 120. So first of all, I really hope that there are some traders in the team who are still in from 118 and 120, because there's no reason if you've got stock from that price that you should be out. This thing is just relatively strong, broke out through levels, has been consistently grinding up. But there's also been no new setup to enter over the course of the last 4 or 5 days. Today, with a gap down into the 80 MA, maybe you could have been looking to go long versus like the pivot from the 6th or the pivot from the 5th. And it was a great opportunity that the market provided to be able to get stock on a relatively strong name on the daily chart overall. So this was definitely one that was worth, I think, having on the radar for today, and I noticed that too late. But anyway, Meta was holding in very well when the market was selling from 935 to 945. It sure was, and that's one thing that we were talking about paying attention to. I think that was DocuSign yesterday? No, it was DocuSign today. I think John was asking about this DocuSign this morning, and that's the type of relative strength that we want to pay attention to. Like, you know, if you look at what the market did here on these first, on the second, third, and fourth 5-minute bar, SPYs or Qs, you know, what do you want to be paying attention to as a trader in that period of time, even if you're not trading? Like, you know, I do the screen share thing, and if guys ever watch my screen share, which I don't think honestly provides a ton of advantage, but one main thing that you'll notice is that my bottom right chart is linked to focus, and you'll see that chart rapidly changing because I'm constantly typing up symbols. I'm constantly doing this compare and contrast. I'm constantly looking at, you know, what are the SPYs, Qs, IWM doing, and then what are all these stocks that are doing in comparison to it. So you look at DocuSign, like, wow, SPYs just went down 3 bars in a row. If I think this market could pivot back up, I want to try to find a long opportunity in DocuSign. What about Meta? Look, market just pulled back heavily for 3 bars in a row. This Meta barely retraced this opening candle, you know, just basically making a consolidation here. That looks really good. Or you know, Netflix, red to green, market selling back off. Look how well this thing's holding in. So if the market can give me that signal, then I want to be going after these more relatively strong names that were able to hold in so well during that market pullback. That's been something that has been giving us consistent success for a while now. So Meta is supporting you on the daily chart. It's supporting you on the small time frame. Obviously, the market's not supporting you. There was, in my opinion, no real reason to believe that the market was going to give this real bounce today. So again, the if that leads to the then. The if wasn't really lining up. You know, if the market can give a bounce, then I think I want to be looking at Docu, Meta, Netflix, Nvidia, those you know, relatively strong names within the pullback and on the daily chart. The if never actually came together, but you can still pay attention to them off the relative strength just to be independent. But again, you don't have all the layers of probability on your side. Now you're just trading relative strength independent to not having the layer of probability, which is the market on your side. If that all makes sense. So anyway, Meta's holding in very well when the market was selling from 935 to 945. Great recognition. Daily chart of Meta was not extended, but the 5-15, 30-minute charts are bearish. Okay, doesn't mean a ton to me. I entered long at 129.70. 129.70. Okay, I'm assuming that you did that then. Oh, I see. Okay. 128.70 is that low. Ish, thinking I could have a better entry. I hesitate a little bit that it would go down. Whoa. I hesitated a little bit that it would go down. Because of the small time frame, and it couldn't break yesterday's close. Would you mind talking a little bit about it? So yeah, so one of the things that I love, Rex, that you do when you bring these trades to the afternoon meeting, which first of all, I really appreciate that you do that because everyone can benefit you know, from the successes and failures that you're kind of dealing with. One of the things that I love that you do is that you really lay out as much information as possible that was going into your thought process. You're not having simplistic thinking of, oh, here is this candlestick or here is this pattern and I'm going long off of it. You know, the market's too dynamic for that. You need to have a lot involved in your thought process, all those layers of probability, and that's exactly what you're doing. I would still caution, you know, one thing that I see you do sometimes is that you overly rely on layers of probability without an actual technical trade. You still need to have that technical trade itself to actually come in that's independent of the layers of probability. So make sure that everything you're doing actually still has a trade. Obviously pay attention to your entry price versus where your stop loss is going to be. It looks like you waited until after this low came in. I'm assuming you used that low as a stop loss, and that's why you're saying, I don't love my price. That's fine. Obviously, price matters, execution matters, but we can't always have perfect execution, though we do everything we can to have it. If you have to pay up, it just means that you take less size, and you should be leaving room to build in more. So if you are like, oh man, I need to get some stock here at 129.70, I'm going to miss this thing if the market bounces here, the great relative strength, etc. You know, take a little bit to make sure you have it, but leave some room to build in. Like maybe this tail happened on the 950 candle while you're in it, all the way down to 128.82. So I'd be curious to know if you just, you know, kept the stock that you had at the price that you don't love and didn't add versus that low. I'm definitely, if I'm paying up that much, I'm definitely leaving room in my game plan to, you know, if you started with your first buy at 129.70 and the stop loss is 128.70, I'm definitely leaving room to buy at, you know, maybe 129.40 to add a little bit, or, you know, and then maybe an additional buy at like 129.10, something like that. You could come up with your own game plan, but leave some room within the game plan to build in, get a little bit of a better price, work the position versus your stop loss. Also recognize that the more it pulls into your stop loss, the lower your probability of success, but also the less risk you're taking on the ad. So I hope that helps for your Rex. Cool. Can I go back again to the Amazon trade for Sebastian? Sure. Sure. So happy to kind of just review it. So Amazon, I was looking at $87 yesterday for a trade, long versus 87. This morning pre-market, with the market gapping down and, you know, this name also giving a not great candle yesterday, back down to 87 again. I was interested in it because of the relative strength. I was still concerned because of the market, and I was concerned because of yesterday's high. But pre-market, Amazon was showing relative strength. So I was like, okay, Amazon's still above 87. There is some relative strength there. So maybe if, and this goes back to the if-thens, if I can get some market support, then Amazon could be a name that I want to look at for, you know, for a second day in a row here for real continuation. And you can see Amazon opened up green, the market opened up red. The market went red to green, Amazon went green to green, you know, green to even more green. So immediately showing that continued relative strength, and the bounce on it was great. This thing retraced a large percentage of yesterday afternoon's rollover very quickly. And that's something you want to pay attention to. Still have zero market support though, right? Market's still stuck in between a rock and a hard place. And this thing, you know, builds out an interesting pattern here. I remember looking at it versus like these lows as a long when the market pulled back, because this one the market made new lows, and it's like, okay, well, this one didn't make new lows. So if the market fails to continue to the downside, this could be a name that I want to look at. And then it kind of built out this like bullish pattern here. I don't have a name for it. Maybe it's a bullish consolidation. It's still relative strength compared to the market. You have intraday resistance at 89. I think, as you know, I don't love intraday support resistances trades, but if I'm able to couple it with other layers of probability, you know, like the relative strength, then fine. So the market was applying a little bit of upside pressure, and then this thing failed off of 89 again, but kind of created the higher low with this 10 a.m. candle. So the trade that I started communicating to the VTF over the course of these 10 minutes was a buy through 89, a buy through the intraday resistance. If this can go through 89, then maybe we get continuation off that strength. And the stop loss I would want to use, and I said you could use a momentum stop actually of the 10 a.m. low, which would just be 25 cents risk, so that would be less risk, but the stop that I felt more comfortable with, where I would know that the idea itself was probably wrong, was the 10 a.m. low. So that was the trade. Buying through 98, versus 89, buying through 89, with the stop loss at the 10 a.m. pivot low of 89.34, so you're taking 67 cents risk in it. Or you could use the momentum stop, which I didn't like as much, of 88.75 and take 25 cents risk on it. Unfortunately, the market weakness, which was never on our side, and the market pushed to new lows, forced this to fail regardless of which stop, but it was still a decent break higher. So that was the Amazon trade. Right there. Rally-based rally to me, says Judy, and that's the same exact thought process. Rally, you find a base or a flag or a bullish consolidation. It's all kind of the same thing with different words, and then continuation or rally. Cool. From Toussaint, I loved the class on trailing on trend days. We need a class for scalping on these choppy days. Have you made one yet? No, I haven't. I don't do as much pure scalping anymore, to be honest. I take scalp trades where I look to have longer holds in them. Everything that I trade, I'm always looking for the bigger picture, and I want the reward maximization on it. I don't like liquidating, and I almost never do it anymore. Liquidating 100% of a position into a rally or into a move in my favor. I find that big picture, it's reward limiting. I have no problem with partial scalps. Selling 50% of your position, get the risk covered. Sell another 25% of your position, make sure you're going to make money no matter what. But at least keep 10% of the position. You're going to make money in it no matter what. See what that thing can do for you. If you find the right market, and I know that the last year or so has not been the right market. Well, last year or so in some ways hasn't been the right market, but in some ways it has, because there have been these massive rallies and sell-offs where, I don't know, how did the S&P close at the end of 2022? Down, I think it was not quite 20%, right? But if you go back and you look at the scale of the bear market rallies and sell-offs that we had over the course of the year, I mean, if the S&P closed down, just around 20% on the year or something like that, we had multiple intra-year rallies, at least 3 that I can think of, that were like 12% or more on the rally side. So if you hold, it might start as a scalp, as an entry, and by the way, those classes are there. You look at the first class at a breakout, that's the first class I teach because it's a very basic, simple trade. You could take that as a pure scalp. It starts as a scalp. But then, I'm a big believer from a reward maximization perspective, hold a percentage of just about everything. Make the market force you out of that last bit of your stock. Next thing you know, you might be putting trades on at the low of the beginning of one of those 12% plus rallies that we had last year. And, it's nice to pad your wallet with a little bit of extra cash from a scalp, but the big P&L comes from big moves. Really big P&L comes from big moves on big size. If you can combine that, it's incredible. But once the risk is more than covered, you're in a win-win-win-win situation. Keep some. If you get that 12% rally, if you get that 17% rally, you're golden. Let alone if you get the bottom of March 2009 and continue to hold it, or the breakout that I had in Microsoft that I ended up holding the trade for like 6 years or something like that. Because it just kept going and going and going and going and going. And I'm like, okay, if you want to keep paying me, I'll let you keep paying me. I'm not going to stop you. So yeah, so all those trades in the classes, a lot of them, you could take them as scalps. The candlestick trades, the breakout trades, and in some ways we do, especially with the one-to-one kicks and things like that. But then I have found, as my career has advanced, that full liquidation of positions and always going home flat is actually reward limiting. I didn't keep a single position overnight. I don't think my first 3 years at T3. I closed everything out. A ton of scalping based on a lot of different things. Tape, charts, lots of scalping. But the longer I've been in the business, the longer my holds have become, and I'm not afraid to let stocks really run in my favor. I'm also not afraid to give back open P&L. As long as I'm in a win-win situation. You know, if I'm in a situation where I'm going to make money no matter what, it's either going to be a little bit of money or a lot of bit of money, I would rather make a little bit of money than a medium amount of money, if that makes sense. Meaning, the position's working in my favor, I give back some open P&L and only make a little bit when I could have made a little bit more. I would rather make a little bit of money than a medium amount of money. Because if I'm willing to give back some of that profit, that I've made, where I'm willing to only make a little bit on it, it puts me in a situation where I might make a lot of money. And that's what I really, really want. At the end of the year, when I go back and review my year, and hey, guess what? It's January 10th. I always find that it's the really big winners that are year changing. And that might be what you've done just over the course of a couple of months of an entire 12-month period of time. And it's also those periods of times where you had no risk management and no money management on the downside that are also completely game changing, and are the reason why you were not as successful as you should have been. So it's both sides, but it's the outliers. Everything in the middle is kind of noise. It's the outliers where you failed to manage risk, and the outliers where everything really came together and you held and you caught a big move and caught big P&L that makes an entire year. I remember when I was a newer trader talking to Mark Sperling, and him telling me that he makes usually 90+% of his year in 2 months of the year, and I didn't understand it back then. I was a newer trader, I only day traded, and I was like, what? That's kind of crazy. But now I totally understand it. It makes complete sense to me. It's certain periods of the year where things line up properly, and I nail it correctly, the execution correctly, and I hold it properly, where it makes a lot of money for me. So I hope that helps to Saint and Judy. Okay, cool. Looks like we got through all the questions today. I'm going to get out and go shovel some snow. It's been snowing very consistently here, and it's shoveling right now. I mean, it's snowing right now. If you're watching on YouTube, give me a thumbs up, all that good stuff. And we'll see everybody tomorrow morning. We'll see if we hold our levels with our gap tomorrow or not, and take it from there. Have a good night, everybody.